Hello, welcome. This is the first and only magazine show with the latest news and information from the UK energy scene. Oil or diesel, wind or solar, it's all here in the next 30 minutes. Welcome to the UK Energy Show. This week, Donald Trump announces new sanctions on Russian oil companies. There is an immediate effect on global prices, but will it change the cost of petrol and diesel here? One of the companies in the US president's sights, Lukoil, has said it's going to put some of its international assets up for sale. In Europe, it owns refineries in Bulgaria and Romania, and around half of a third one in the Netherlands. Will there be any buyers, though? Also this week, the collapse of Petrofac. The oil company employs about 2,000 people in Scotland. They say their North Sea business will continue to operate as normal. In a statement, they said they had to appoint administrators for its holding company, but that alternative restructuring options were being explored. We'll get into the details. And helping me to understand what's happening are experts. Greg Newman is the chief executive of Onyx Capital Group, and Julian Keats is a senior consultant here at Flux. Let's start with the Donald then. Before he went off to Asia, he did this move. Rosneft and Lukoil are two companies. We'll come on to Lukoil in a sec. What do you think the impact, what was the impact of hitting these two companies in particular, Greg?
Hugely significant. I think on the face of it, it was seen as yet just more sanctions, and maybe there was some headline fatigue about that, just saying, what's the big deal? This is huge. The reason why is because in 2022, when the initial sanctions were in place on Russia and oil and gas, it was all about directly importing Russian oil into Europe and the US. But what really happened was it just simply circumnavigated around the globe. And we did talk about that a little bit last week or the week before. So that just continued on. So if you like the big pool of oil, that was the export market, which is freely traded, wasn't really materially impacted. This time, what they've said is we're actually going to directly sanction the producers, Rosneft and Lukoil, who are huge. And not only that, they were going to be a lot more aggressive on the secondary sanctions, which is sanctioning Chinese and Indian companies that were buying the majority of that Russian sanctioned oil. So now it's cut off huge outlets in China and India, in fact, the biggest outlets, and it's also directly sanctioned the producers who are exporting it. So what we're going to have immediately is very similar to the Iran situation we've actually had for quite some time now. And if you go back to Trump's previous term, he had a maximum pressure strategy on Iran, which was saying, let's get their oil revenues as close to zero as we can. And what happened was an enormous buildup of what we call oil and water. So Iran is still producing the oil, they then put it on ships and leave them floating around. This is now pretty much the exact same scenario for Russia. They're producing a lot of oil. It's finding its way out into the oceans and it's sticking there. It got to all-time highs recently, and this was before the sanctions were announced. So already the sanctions were having a big impact. Now you've got these very level up sanctions. It's an incredible two-tiered market. Got a huge amount of sanctioned oil that's going to just build up and up and up. And you're going to have the freely traded market, which is incredibly what we call tight, incredibly lack of oil, because you've just taken out, a huge number of barrels, 5 million barrels per day plus. So that's really significant. So oil prices were on a big downward spiral, long-term trend all year, immediately spiked off the back of it, complete reversal, speculators scrambling, to be honest with you, a lot of money lost, and now trying to gather what's coming up next. A very uncertain market, but look, from the objective look at it, this is incredibly bullish for prices, as we say. And I think, if anything, the market's probably underweighting it right now. And just to finish this off, we were concerned about diesel throughout the whole year because of the reliance we have on Russia exporting a lot of diesel for the world. That's now been exacerbated, 3 or 4-fold, and you are starting to see the prices in diesel as well as global crude prices.
We're seeing that in our headlines again, aren't we? Julian, just remind us of this. They call them shadow ships, don't they? Because these sanctions have been evaded. They've been got round for many, many months. How do they do it?
And well, that's a really good point. I mean, and many analysts argue that is a real risk. So a ship needs a responder that transmits where it's at. If that's switched off, it goes black, dark, shadow ship. It effectively goes off the reporting grid. And that ship now is handling sanctioned goods. It's buying, the ship owner or whoever's renting that ship is effectively paying for that ship in a transaction where they'll get cheap sanctioned oil and sell it to market as unsanctioned oil at real market
And there is
values.
a market for unsanctioned.
I've never been involved in it, but I've heard absolutely there is a market for this.
Can I cut in there?
Yeah, absolutely.
An enormous market. And this is what led to 22 to now a big boom in companies in Dubai in particular, places like Singapore as well, who are okay, at least with the sanctions as they were. It's the thing with commodity trading and oil trading is it's a lot to do with the financing, and it's about the banks. Now, if the banks are comfortable because they see the sanctions as European based or US based, and there's some way you're avoiding those countries and avoiding a fallout, then they will finance it. What's so different now is there's such sweeping sanctions that no bank, I think, really
They're not
in
gonna
the world
touch it.
wants to be anywhere near it. But it's not
Really?
about touching the oil, but touching the companies that touch the oil.
Yeah.
And I think they're under so much pressure. And even if Trump was to say, do you know what, we're going to relax the sanctions, they still will be unlikely to be keen to be involved in financing, because what if it switches again? We had a scenario in Sri Lanka even where the oil was coming in, or sorry, I think it was the LNG was coming in, actually liquid natural gas. And by the time it arrived and by the time it was time to pay, they got sanctions. So they couldn't even get paid for what they delivered. It can be that quick. And for a bank, it's a nightmare. The money's trapped and it's lost in transit.
That's a hell of a risk to weigh up, isn't
And
it?
it's guilty before. This is not like normal courts, right? This is guilty until you prove yourself innocent.
Right.
So instant.
I think you raised a really good point there, Greg, and what I wanted to add to it was actually the UK imposed very wide-ranging sanctions on the 15th of October. This is, Trump announced it on the 22nd, 23rd of October last week, right? So the UK had already moved, which I think is a really positive move as well. So these really are wide-ranging sanctions, but it's that second tier that you just mentioned, Greg, that's the real one. Now, the sanctions take full effect on the 21st of November, right? That's when they really take full. So if they really do get policed down to the level, that second level, then the ramifications are very significant.
when you say
We're
if
seeing
they
all
really
up to
do-
80 or 90.
I mean, Trump has proven he will.
And I
There's
think
no
you're
doubt
right.
that he will do
I mean,
it.
India's going to stop buying without a shadow of a
They've
doubt.
already,
They
they've
will
already
back
said,
off.
and we've seen that their big company, Reliance, that they've already announced themselves they are
Totally agree.
switching their buying to the more Abu Dhabi related oil. And that's significant because there's a big thing going on, like I said, this two-tiered market. Now, the free traded market, if India are turning their buying towards the free traded market, they're adding a hell of a lot of competition to an already highly competitive market. That just causes price increases.
Got to bring it up.
Yeah. So you'll see all this oil in the world, but ironically, that's not setting the price. And that's going to drive people a bit nuts. And there's a lot of pressure from the public probably that will come.
Maybe we should just quickly get a chart. Diesel prices circled there in red. Last week we're about 43p. That's the raw commodity cost of diesel. That builds up to the price that we see at £1.43. You can log onto our website and see this for free. It's on the website. So we've seen prices move 2 pence a litre as a result of sanctions last week. So it has had a direct impact on UK affordability, people that are buying gasoline and diesel for their car, but also an indirect one, because when you order on Amazon, that stuff gets delivered by a truck that's burning diesel. So, and this is true for all your food goods and anything else, consumables, right? So it has an impact on affordability across the board.
On the Lukoil question, and that's a private company, isn't it? Rosebank is a sort of nationalised one. Lukoil is in theory a private company, although I think they pretty much
Might argue
told
that,
they have quite a hotline to the Kremlin. Who would want to buy these refineries? Because there's no point in owning a refinery if you can't put crude in the front end, right?
Well, the refineries in Europe, it was more going back, and we saw this in 2022. Divesting and optionality has been changed around within contracts and all that in order to stay compliant and it to be majority owned or ran by European-based companies, if not the states directly, like the German states, for example. So this is just an extension of that. I think if they can divest enough to get it down to you can prove control by European companies, then they consider themselves okay. So I think it's the opposite. I think if anything, the fact that it's now open, it's not owned by Russian companies, means those refineries can more freely be available to operate.
On the upside.
It's an upside in terms of supply and function and operations, not an upside for prices.
I think it's a fire sale as well, so the price is going to be low.
So it's a bargain. If
It's
someone's
probably
in
going
mind
for a
to
bargain.
buy a refinery, now's the time to do it.
And running a refinery is not a cheap process as well. So.
And it's not a politically, people don't want refiners. It's not.
Yes.
It's not a good climate for buying
Yeah.
refiners. You see Shell, BP, they're all trying to divest their refiners as well. So it's coming at a time where, as you say, it's.
But maybe that's actually reversed. You're right. In 21, 22, they were trying to divest. Shell was very busy trying to sell it. But now they seem to have pulled back from their green agenda. Right?
Well, this is it. So what happens when you have basically these arbitrages available, right? Discounted assets. The private equity guys get involved. The people who can spot.
There's always a buyer.
There's always a buyer, distressed assets. It's better. It's the companies that are involved in our everyday supply benefit from that and know how to run it. So look, to be honest with you, I hope that BP can change tack and say, right, look at all these cheap assets. Let's buy them up and let's get operating. But they're under a huge amount of pressure as a public company. We've seen that for years. So.
Let's come right back to the North Sea, shall we? Petrofac is another company in trouble, or more correctly, I think, Greg, it is to say it's their holding company, their parent company is in trouble. But these 2,000 job losses coming in Scotland, and actually we've got a clip from the House of Commons. There was an urgent question being asked there. The Tories are pretty angry.
Today, the energy giant Petrofac has entered administration, casting doubt over the future of their 2,000 employees in Scotland, as their global HQ is in Aberdeen, and countless more supported indirectly through the supply chain. This is a company that, as the Minister has said, has had issues for many years. But the hostile environment created by this government in the UK continental shelf has made operating here for far too many companies nigh on impossible. Since the 2024 general election, there have been thousands of redundancies in our offshore energy industry. Harbour Energy completed a new round of redundancies just last month. With depressing regularity, Mr. Speaker, we hear of more job losses in the North Sea. Whether that be at Harbour Energy, Apache, Hunting or Petrofac, each job lost means uncertainty for a family, a mortgage jeopardised, investment fleeing our communities, and our world-class supply chains and skilled workforce pushed towards extinction. Minister, how many more of these will it take for the Secretary of State for Energy to change course? These are political choices. This is a manufactured decline. As a direct result of the hostile trading environment, the close for business sign is hanging over the UK continental shelf.
Well, that was Andrew Bowie, the Shadow Secretary of State for Scotland, giving Labour what for in the House of Commons. Now, there are a particular set of circumstances relating to this. Julia, just fill us in. Why has this happened?
So, okay. Firstly, I think Andrew is gerrymandering politically there. So the key facts, if we think about Petrofac, they're an oil service provider. They're not a producer. So should they come out of administration, not find a buyer, and it collapses, which would be awful, obviously, for the 2,000 people that work there. Let's just recognise that. But in terms of corporate point of view, we're not going to see a reduction in oil production in the North Sea, right? So that's really important. In actual fact, what Petrofac have said is that part of the business is profitable. It will continue. So they will find a buyer for that part of the business. And I'm not sure if that part of the business is admin or not. Okay, so that's really important. And actually, why are they here? Directly sort of contradicting what Andrew was saying. This is to do with a court case in 2017 where they were brought to court for anti-bribery, for bribery charges by the Sirius Ford office.
And it cost them a lot of money in the end.
And it cost them, I have the number here, I think it was 77 million. Okay. Now, they haven't actually made money since 2019. And that bribery case was brought in 2017. It was concluded in 2021. Okay. And during that process, they found it very difficult to get more contracts, because one of the key things when you're getting a contract is you cannot have any bribery cases. You're not going to get a government contract. So this stops them.
Doesn't look great when you're pitching for work, does it?
It means that you're really, in the oil industry, you're really going to struggle. So actually, they picked a lot of contracts that were very tricky to develop on. And interestingly, one of those was a renewable contract for the Thai oil company, Clean Fuel, that actually Petrofac wasn't a specialist in, took on in 2018, and they couldn't deliver on it. This cost them about 200 or 300 million, and this is what's really pushed them over the edge.
Okay, Greg, let me just ask you, though, about the wider ramifications. Is this going to affect us all? Is it going to affect you and me as consumers?
So maybe not directly, but I think the big thing that's important here in this highlights is a bigger political issue, which is we don't seem to understand in Britain that we are responsible for a huge amount of growth and the beginnings of the real freely traded oil market. The price of Brent, which is a UK-based benchmark, and it's Brent is a physical crude oil that's produced in the UK. That price is 80% of the world. It's a bit like the dollar, everything, the reserve currency. Imagine that for oil. Brent sets everything, and that's UK based. And the amount of expertise that went into developing those fields, the drilling, the offshore capability that Petrofac do have, this is what it's all about. We in Britain, we are so good at this. We're such experts. We've built an entirely financial ecosystem off the back of it, a huge export services foundation off the back of this. And 50 years ago when it started and to now, it's an incredible expertise that people around the world sought after. The commodity talent we have is incredible. Most of the derivative trading, the financial side of things, goes through London. It's a massive hub. So when you're complaining about these companies and how bad it is, you've got to remember it's a bit like that argument against bankers in '08. They get paid too much money and this kind of thing. But London banking is the hub, and they get a lot of bonuses. They pay a lot of income tax, and being the hub is great news for our industry. For our economy. So we've got to highlight that more with the oil market. This company, Petrofac, was exporting their services around the world, particularly Iraq. That's huge for our economy, right? We're exporting our services and killing 2,000 jobs. Deep expertise in Aberdeen that's been built for a long time is a real disaster. And to not only say that it's lost, it's also signifying we're just letting this industry die. We were the pinnacle, and now we're just giving that away, and US companies are coming in and lapping it up. And that's what's really sad to see. And I think that's the wider political point that is very important. And just to finish that off, you could say there's nothing to do with the tax regime. It's nothing to do with UK politics. But it is a bit, right? Because they were not able to be competitive. And this is what economies are all about. Where are you in your global competitiveness? If to produce oil is at 78% tax, and you've got service companies like Petrofac who need to service the companies that are producing at that 78% tax, guess what? They're not going to be competitive. The margins are going to tighten, and they've got to pay the kind of salaries you get in the UK rather than, somewhere cheaper abroad. It's no surprise that it's starting to die out, and there's no support from the government. If anything, it's complete opposite. It's trying to kill an industry of which we're world class at, and that's not nice to see. So I think it's important to mention all that.
I have to come back on that.
Go on then.
So I would say that, from what I can see, that the service industry is viable, so the jobs won't be lost. They're at risk, so they won't be lost, is what I suspect.
You're going to argue the detail, not the principle.
So no. And in terms of principle, I think Petrofac, it's in this position, not because of the UK government, because of its poor governance. And that's different, very, very different.
But that's because you're arguing the detail. As in, like, at the end of the day, the idea that Britain is a hub for the oil market and it created a lot of what the world uses.
But it isn't UK government, and it's not because they don't want it.
But does it not signify, though, that we are uncompetitive or losing oil refiners, going from 18 refiners down to 4? That's not this general trend.
I think the bribery case starts it all off. That's what stops them getting more contracts.
So what about the refiners going down then?
But that Petrofac's not a refiner.
I know. It's a general principle. I'm saying that our oil and gas capabilities and us as a hub, we're ignoring it and we're letting it go.
All I'm saying is I think Petrofac's nothing to do with the UK government and not ignoring oil investment. That's
Let me
about.
just throw in a decision that has not been made yet, and it is come down to what government do and how it impacts the oil industry. And that is, there's a question about this Rosebank and Jackdaw, 2 oil fields, and gas, I think, is involved as well. And I think we've touched on this before, but there's a decision pending because the Tory government said, let's go ahead, let's explore these places, let's see if we can make some money there, let's get some fuel there. And then a Scottish court intervened and said that the proper consideration of the amount of non-clean use of fuel hadn't been taken, so the whole thing got stuck. Now we're still in some kind of weird thing. I was phoning the department only the other day to ask, when are we going to get this decision? They wouldn't say. It just says when everything has been considered. Who's doing the arguments, Julian? What's the Secretary of State got to weigh up here? Whether he says go ahead and drill.
So he has to weigh up the entire carbon emissions, which is why it failed, because they ignored a particular scope of emissions. When an oil field produces, that crude goes to a refinery, and then the ultimate refined product is burnt wherever it's burnt. All of those, the global emissions associated with that production, what was ignored was the scope 3. So when that diesel jet fuel gets burnt by a plane, a car, they ignored that in the reports. That's why the Scottish Government threw it out. So they've now rescoped that, or they're in the process of rescoping that. So he's got to look at that and say, is it worth, and to Greg's point earlier, is it worth us investing this, given we've got net zero targets, 2030, 2040, 2050 net zero, and a sloping profile to that, to invest in this, to give jobs, tax revenue, balance the fiscal books, as well as getting to our net zero targets. And actually, I should need to correct the record. Last week when Greg and I were talking, I said I thought in my quick analysis it probably wasn't economic. And I suspect, and again, I don't know Equinor. Equinor is the current stakeholder for this field.
Yeah.
The field is in very deep water.
Norway
It's
state-owned, we should say as well.
Yeah, state-owned. It is 80 miles offshore in the off northwest's Shetland, right in a very difficult location. So this is expensive to produce. So the investment to build the platform is expensive, but actually from the analysis and stuff that is available on the internet, it looks like $13, $14 a barrel. The operating costs, again, looking at Equinor and a couple other and Restart research, probably another $25 a barrel. So we're talking about $38 a barrel. Dated Brent, let's get that price up on the screen now. The dated Brent prices, the forward curve. And when you're in developing a field, it takes 2 or 3 years to develop it. So you need prices 4 or 5 years out. That's the spot price for dated Brent. And dated Brent, just so you're clear, this is on Flux Markets. This is the physical. When you think about Brent, you'll often think about the futures, but this is the real physical assessment you've got on Flux Markets. The Onyx trades every single day. And what we've got on the right-hand side there is the forward market. Can we go to the next slide where we just zoom in on those forward numbers? And what we'll see is it's at $65 to $66 a barrel 4 or 5 years out. So that actually, if their cost, my analysis today, which I spend a lot more time on, $38 to invest and operate, dated Brent's at 65, it's economically viable from an economic. So Equinor should be a yes.
So your point, we've got all the infrastructure, we've got the expertise we need to get this done. So would you be on a drill, baby, drill phenomenon for that particular
Absolutely.
case?
I think generally always, because I think that we are still using oil and gas a lot as a country. We still import a lot of oil. As I was just saying, the refineries going down more and more, losing all this stuff that was so great and we were such leaders in is just a massive shame. And conversely, like Norway, who we're talking about, these JVs, and they're right next to us in the UK North Shelf. They are also big on renewables, apparently. They talk a lot about it, but yet they have very well functioning refineries and production, and they're making a hell of a lot of money, and they've got a $2 trillion, what's it called? Fund. Sovereign equity fund. So yes, I would obviously be on that side. I think UK should be going more that side. But to answer your original question to Julian, what is he going to be weighing up then? Just Energy Secretary of State, the
Secretary of State for Energy.
Is can he handle the political pressure? Because it's not really an argument when it comes to commercial. It's
quite simple, you would say. If you took all the political
more
nuance.
jobs, more tax receipts, more money locally, less carbon emissions, because you're going to have to import carbon emissions if you can't produce it yourself. So it's less. There's no argument. The only argument is because we don't want to be seen. Can you do it politically? Is the public going to have backlash and all that kind of stuff? Cue you to cut.
Yeah, and I would say, what we just need to be cognizant of is that actually the tax receipts are negative initially. There is a massive tax benefit for Equinor to develop this. So instead of getting all the tax receipts on their profits, because there's such a big development cost, HMRC is saying we're not going to tax you at standard corporate rates for the life if you invest in this. The tax receipts will come later.
So Equinor are the ones leading the charge.
Yes, absolutely.
For a UK-based production. Do you not see how crazy that is? So a Norway-based government company would take the risk on a UK production asset.
And you and I and everyone else watching this is taking the risk that if oil prices fall, there's no tax receipt in the future benefit, right? So
but just the irony of the government not wanting to do it, yet a Norway government company will do it.
Yes, that's absolutely ironic from that point of view. Yeah.
It's one to watch. And I'm sure we're going to come back to this when the decision is finally taken. Okay, Julian, while we're looking at charts, let's just check on the latest stats you've got for us on petrol prices and gas and so on. What are the latest charts showing?
Let's just go back to that chart. Can you get the diesel chart up, please? So this is, again, if you're a subscriber to Flux Markets, you can log on and see the ex-rack diesel price. You can also see the pump price as well. The ex-rack diesel price here, you can see the jump up in prices on the 22nd of October. We were talking just now about the US sanctions. Just note, UK sanctioned them on the 15th. You can see no movement in prices there. That kind of says something about how the world reacts to the United States, doesn't it?
Trump's more powerful.
Yes. Potentially, but a really good thing that UK made that statement too, I think, in my personal opinion. So we can really see prices jumping up there.
Can I also say that's not a mistake that it's gapping up. This is the function of the oil market. It closes over the weekend. And so you can just be one price on a Friday night and then you open on a Sunday night and bang, it's higher with no trading in between. So that's why it's dangerous generally.
And then if we just turn to the dated Brent, you can just see here front month dated Brent. And just to remind everyone, this is not a financial contract. This is a financial contract, but it's actually marking physical dated Brent, a cargo with a potential date coming on it into the North Sea. So when we're talking about Rosebank, this is the price that's really relevant, not Brent futures.
But it's very similar to Brent futures.
It is very similar, yeah, absolutely. I was just going along with this. It's actually really important to see.
Yeah, definitely.
So, and again, you can see here the price is jumping up, those two green bars on the 22nd of October.
All right, we'll keep an eye on those stats week by week. Next, we should abandon the ambition of clean energy by 2030 and focus more on the energy costs faced by consumers. That's just one conclusion of a new report from the think tank, the Tony Blair Institute. The report's author is Tora Langenyan. I spoke to her earlier, asked her why she was proposing a delay to the clean energy ambition.
Yeah, so I think our argument here is multifaceted, but essentially clean and cheaper meant the same for a long time. So renewables was, especially kind of during the gas crisis when this was announced, renewables was the cheapest way of producing power. I think what we're seeing now, though, is that Britain is facing a situation where we have the highest electricity costs in the developed world, and renewables is part of the reason why that is happening. We have not built out the grid at the speed that we need to, and there will be significant investment that will be needed. So, we have really high additional costs of integrating renewables right now. So we are just saying there is no reason that we need to be sprinting for 2030 right now. We can go a little bit slower, focusing on what's best value for money, how we start lowering energy bills, rather than focus on those small emission reductions that you might see from 2030. And I think that is a more sustainable path, really, to net zero, because firstly, the big challenge in terms of net zero right now is reducing emissions from all the other sectors of the economy where we need to electrify them. And obviously, electrification is easier if you have a lower cost energy. And also, if we want to keep the public on side, frankly, it will be really important that electricity becomes cheaper so that people support the transition as we go along.
So I understand your ambition to try and bring down the consumer's power costs, particularly electricity costs. Well, there are some casualties in your plan. I was interested to read that, for instance, carbon capture. Now, there's been a lot of work done about that, and there are a lot of evangelists who say this is the next big thing. But you suggest that should be parked altogether. Tell me why.
Yeah, I think this is. I think the really important thing that we're saying in the report is that this is just parking CCS for power for the time being. So we're not suggesting that the UK should step away from CCS more generally for industry, for instance, where we have very few alternative ways of reducing emissions. But the reason why we're saying this for the power sector is because we know that CCS for power is going to add significantly to consumer bills. That is because the process of removing emissions, especially where the tech is at in the tech curve right now, from gas-fired generation will be very energy intensive and very costly, which at this stage when the UK is facing such high costs feels like a cost that we really can't afford right now, and it's not in the interest of the wider transition. So the few kind of emission reductions you might see from CCS is not worth the additional cost.
You also want to make gas cheaper and argue that's an important imperative in bringing the public around. If Ed Miliband reads your report and does it all, by how much do you think my gas bill might come down?
Well, first of all, your gas bill won't come down on the back of our report. Your electricity bill could, though. We've not done the full work of costing all this, because in reality you have to basically have the kind of central government analysis machine on this, because what we're suggesting are a number of different interventions that could that works in several different ways within the system. However, in terms of the gas intervention specifically, that could probably save you around £20 per consumer per year, which is not a huge amount when you look at it like that. But you could also choose to focus that on lower income households or those struggling the most with energy bills. And as I say, it's only one lever in a bigger part of levers. But look, the reality is reducing the UK's electricity prices is not an easy task. There are no quick fixes, and anyone who tells you there are quick fixes are wrong, frankly.
Yeah, I mean, it was said, wasn't it, I think in one of the hearings recently, that even if wholesale gas prices come down, the amount of other tariffs that tot up on top of the bill might see electricity bills continue to climb for the foreseeable future. That's not a great bit of politics, is it?
No, absolutely. And I think this is exactly why we have written this report, because our big concern is that we're basically living in a world where electricity bills are set to just increase and increase and increase. And basically what we've seen is decades of policy making. We have not put significant focus on all of those costs that kind of add in together. So what our paper is about, and our intervention is mostly about, is to say, look, we need to stop this upward pressure on bills. That means recalibrating the current energy mission, and it means start addressing these, individual policies that are adding onto costs, which is things like we've already talked about, CCS, gas, etc. But also thinking about putting, for instance, a cost cap on the upcoming auction round to make sure that consumers are getting value for money, and those kind of non-commodity costs that Octopus was talking about don't spiral out of control.
Tora, thank you very much indeed.
Thank you.
Right, well, let's see what Greg and Julian make of that. We should be patient, actually, and tell consumers, let's make your fuel just a little bit cheaper and park that ambition until 2050. Your thoughts?
I think my initial thoughts are, it shows the complexity, right? It's very hard to hone in on what precisely we're going to do. I think the way I read it personally is this is more rhetoric coming through to softly kind of allow Labour to shift policy. It's Tony Blair Institute, it's more Labour focused, it's allowing them to have other experts to say, maybe this was a bit of an aggressive transition, we're going to slightly change tack and avoid the public backlash. That's all I can really gain from that, because not a lot was said that is new. But having said that, I welcome personally the pragmatism, right? Trying to target £20 a month, a year, reduction to begin with a year. It's true. I mean, trying to be more basically lowering the bar, saying £300 off a year, like Miliband said, is an incredibly ambitious project whilst you're still got all these levies and renewable obligations and all this kind of stuff. So at least I welcome that, but that's all I can really say on it.
I think, you know what, yeah, I think you're right. And I think the key thing for viewers is affordability. There's no two ways about it. 20 years ago, power and gas was so much cheaper. Now it's very expensive. Most of those, what I read from that, the Tony Blair Institute takeaway is I think as long as we have 2050 in mind, we need to be sensible. So I think I agree with this. I don't think we need, 2030 is really an arbitrary target, but we do need to think about all of our energy needs, and we need to think about how do we fairly tax people. I've read some comments on Flux Market's response to this show, saying, what about going to, taxing everyone in the UK? But not everyone has power and gas consumption needs. Some people are just power, some people have solar generation. So you can't just tax everyone that way. What I think is really unfair, having thought about this the last 2 weeks while we've been doing this show, is that actually gas for heating is very cheap. And all of the tariffs have come in to decarbonise, which are needed, into the power price. So my power price is capped at 26p today. Electric price, thank you. Yeah. The electric price is 26p a kilowatt hour, and my gas price is 6. Maybe those two need to be a bit, we need to think about how we bring down power prices and maybe raise the gas price. But for some people that would be unfair, and there are other people's that would be, and it's difficult to balance.
Well, it's going to be a hot issue for the next few weeks, right up to and through the budget, I'm sure. So we'll get more on that as we'll report on it as it happens. This is the UK Energy Show, brought to you by Flux, the biggest news, information and trading platform for world energy markets from Onyx Capital Group. Now, we'll talk about social media. What is being talked about on social media? Well, our show has been for a bit. We had some feedback, I think, to edition number 1. And we can show you some Reddit clips, I think, of some feedback that we were given. This is a screen grab we've got from one of the contributors there. And actually, Julian, speaking to your turn, gas sets the price 98% of the time. I don't know if that stat's exactly right, but it influences the electricity price, doesn't it?
Absolutely, it does. And one thing we've got to think about, the gas going into the electricity price, you need 2 units of gas to produce 1 unit of electricity. And also for gas being burnt to produce electricity, there is a carbon tax that comes into it that really inflates the price. So your gas, when you look at your gas price for heating, that doesn't exist. It's 6p. And the power price is 26p because of this fact. You need 2 units of gas. And then on top of that, there's a carbon tax that comes into this. So back to the point earlier, if you were going to make things fairer, maybe you need to redress that balance.
Okay, back to Reddit. And here's a comment from a housing developer in Scotland. Huge infrastructure upgrades are happening, but it's so far behind, unable to deliver to homes because there is not a power capacity to deliver. This is the electrified delivery system, isn't it, as well?
I think this is the fairest point you can make, is that even if you're completely pro what we're all doing in the UK, it's just hard. It's going to take a long time. It's transition. We use that word a lot. And I don't know, was there over-promising on how quickly this would be done? You could go back to 2021 and see all the investment that was going in, the companies that were being started, that were being launched and had enormous investment, enormous valuations, because everyone was so pro this movement. Mm-hmm. I don't know how you can put more behind a movement, and yet it's still far behind. That just shows you the scale of the challenge. And that's the fairest point I think you can make.
The scale of the challenge is huge.
One final one to look at. Let's have a look at this. Why is the old program lack of investment? Why have energy companies in particular, been continually underinvesting? Because they've been allowed to get away with it. Oh, a regulation question. Have they been lax?
I think that's quite a sweeping comment, obviously. But I would say, generally speaking, if you want people to invest, they need to be looking 10, 20. I mean, look at Onyx, right? We got revenue, we got profits, we got cash piles, and we take a look at the market in a cyclical view. And what do we want to invest in? Where do we see the future going? If it's going more electronic trading, we need to invest more in infrastructure for electronic trading, these kind of things. Companies are just going to do the same thing. Being forced to invest in things, I mean, that's a different type of economic environment, I'd say. So if you want people to invest or companies to invest, you have to provide the incentive. That's pretty basic stuff. And that's what we're going on about. A very high tax regime and a politically shaky landscape. That's what Ineos is going on about, Ratcliffe. I mean, I don't want to invest here because it's so unstable. So if you wanted them to invest in the grid infrastructure, you've got to make it investable. But the idea that it wasn't attractive for renewable investment, that can't be right. The subsidies have been amazing. Like people have made, Elon Musk built Tesla a lot of the early stages, a lot on subsidies. I know it's the US, it was definitely not a bad environment for investing in good infrastructure.
No, and renewables have come on in force. You know, you just mentioning earlier off air, 60% production yesterday, 50% of our power needs yesterday was wind yesterday, renewable production. And that factor is true, and coal now stopped completely a year ago. But in terms of investment, that's why GBE exists. It is an investment.
It's Great British Energy.
Great British Energy, yes. So Labour set that up as they came into power, and that is an investment fund that's going to take part, private investment and part of their own investment to put their plans into action, right? It isn't a producer, it's an investment vehicle. And at the same time, they didn't privatize, they nationalized the national grid operators at ESO, National ESO, Electricity Supply Operator.
Because I guess we just generally disagree, I guess, with that comment.
So I think I think I'm agreeing with his comment, saying actually probably the answer is you need to nationalise part of it to really get the vehicle.
But in terms of, they say the lack of investment and energy companies should have been forced to invest.
Yes, I mean, you can't force them, to your point. It's got to be interesting, but how interesting if they're making a lot of money producing power by burning gas.
But that's what I'm saying. I think I challenge the belief that these oil companies and gas companies are making so much money in the UK that they should invest. They're not making any money in the UK. It's a crap environment to be in. We're here as traders because it's the time zone and because we can trade on platforms that exist outside of the UK, right? It's not like we're going, oh, we just love making money out of the UK population. That's not where the money's being made. It's the global market. And if anything, this is the worst physical market. I mean, we're not physical traders, but see my point?
Yeah, yes, I do see your point. And this is particularly about the utility companies and how they're performing, isn't it? Yeah. So, yeah.
We'll leave it there for this week. Thank you very much indeed. Thank you very much indeed for watching. We do read your comments, as you've just been proved to you. So do add your words wherever you're watching this in the comment section underneath. Until next week, bye-bye for now.